Hey everybody, Courtney Smith here with our April 24th edition of Wall Street Winners. Let's dive right in, and of course this is the high point of the whole thing. Okay, big change in my attitude. What I've been saying is we've been talking about how we were going to have another leg down. That leg started. It happened on Thursday. It's on Friday. That's it. The bear market is accelerating now. I've been telling you it's been a bear market now since the beginning of the year. It's now accelerating to the downside. Here we can see the S&P 500 Thursday, giant key reversal down, follow through on Friday, purple predictor, extremely bearish. Let's take a look at the Dow Jones. Here in the upper right-hand corner, we can see that selling pressure finally broke out after having really not been in power. So this shows that the bears have taken control of the market for the first time really since back here in the middle of March. The NASDAQ, you can see that the purple predictor is accelerating to the downside. The NASDAQ is and will remain the weakest of the three indices. Seasonality, obviously, forget it. We're neutral now on the stock market from that perspective. The utilities are still bullish, although they gave up a little bit of strength on Thursday and Friday as well, not anywhere near as much as the industrials. Now, this is the killer, and this is why we said there's going to be another, the new leg down. In addition, notice that just follow the red line. That's probably the best scenario. This dive down is a much bigger one than the one we had at the beginning of the year. So I think we're going to see a significant decline right now. Yes, I think we're going to follow the seasonality and get a little bit of a rally here and then have another big move down. This is a bear market, and it doesn't mean we won't have, bullish moves. That's obvious. We always have bullish moves, even in bear markets. The last bear market was in 2020, and it only took a few months because it was kind of a fake bear market in a way. But go back to 2008, that one lasted a year. This one's going to last a year as well. Something like that. We don't know exactly yet, but it's going to be a long-term bear market. And then we're going to go into a recession next year. Maybe even late this year, but let's just call it late next year, or early next year, sorry. But right now, the key is we've now turned the corner, which I told you about last week and the week before, and now we're into this new bear leg, which should be bigger than the bear leg we've already had. Now, over here we see asset allocation. Asset allocation had been one of the most bullish features supporting the stock market. That has been kicked out. Money went out of the stock market and into the safety of bonds. Risk, however, is doing exactly what I've been telling you it's been doing all along. People are going into the safest sectors of the market. They're not going into the risky NASDAQ. They're going into the safe utilities and things like that. Global shares, bye-bye. Yield curve, we've talked about this a lot the last couple of weeks, so it's exactly the same as it was last week. Bonds, big bear market. Look at the collapse in the purple predictor showing that the smart money has given up on the bonds. Has given up on the bonds, and they're going to accelerate to the downside. Now, I'm going to take it another step further. Not only are they going to accelerate to the downside, but junk bonds are going to lead the way. Junk bonds are going to be savaged and compared to investment grades. The same thing is happening in the bond market that we see in the stock market. I actually have a risk indicator for the bond market as well. Maybe I'll start adding it because bonds are going to be savaged here. So the bonds are going down. The chart here is for treasuries, which are the safest. But if I showed you a chart of, they like to call them high yield, but you and I, we call them junk bonds. It's way worse of a bear market, and it's going to continue to be way worse. Here we can see all of our indicators are telling us we're going to see higher yields in bonds, lower prices. Dollar accelerating. If bonds are going down, then that means that yields are going up. That means that the US dollar is more attractive because yields are not going up as much in other countries, particularly in places like the yen. Euros trying to keep up, but even there, we're going to see the dollar continue to remain strong. If the dollar's strong, gold's going to have a hard time. It's going to have a hard time rallying. So just really want to stand aside there. Our gold key indicators are slightly bearish. I mean, this indicator is very bearish. The top one, which is the euro, is slightly bearish. And this middle one is slightly bullish. But the big one is the yen, which is this green line here. Crude oil, right now, we may be forming a descending triangle, which is not usually a topping formation. So I'm a little bit dubious. I think that volume has gone down. So I keep getting bullish, then bearish, then bullish and bearish. How about I just say I'm on the sidelines and we'll just see what the market does. Bitcoin is going to continue to go lower due to the decline in the NASDAQ. Apparently, Bitcoin traders don't know how to trade the Bitcoin, so they're just trading the NASDAQ now. So it's going to follow the stock market down. People are going to liquidate Bitcoin in order to cover their margin calls that are coming in the stock market. Okay, fully paid up members. This is an interesting chart to me. So I've been telling you for months that it's a bear market based on our primary trend indicator. At least since December, I've been telling you that. Interestingly enough, though, we still have yet to break the low that we made in March. But nonetheless, and this high was microscopically higher, but we did break the mini high here. So I'm going to count this whole thing as still a continuation of the bear market. And I think that we'll probably break this low here on the primary trend indicator here very, very soon. Probably take a week. Probably not two. Okay. Adrenaline turned bearish 2 weeks ago. Great signal again. Dow theory, bearish. So we had the trannies had collapsed at the beginning of the month. Then they got a nice rally. But and then they've hooked down. But the trannies had broken the previous lows, so they had turned bearish, but the Dow Industrials had not. And you can see they actually made a microscopic new high here, but then Thursday and then on Friday, they broke the previous low. So I've now moved our Dow theory indicator to bearish. So this venerable indicator is also saying a bear market. Now, our COGO is saying that interest rates should stay high. But as you can see, they're not just staying high. They're getting higher and higher and higher. So I got, COGO is saying we should see some stability in interest rates here very soon. So that's my official prognostication. But over the long run, we're still going to see lower bond prices. US yen interest rates have been very, very stable. They have creeped up a little bit, but not anywhere near as much as what you just saw on the chart, the previous chart, where we saw that yields are just skyrocketing in the US. They've nudged up a little bit in Japan. So that's the big reason we're seeing the big bull market here. Same thing really in the euro, although euro rates are going up a little bit faster than yen rates. Commodities, I think the interest rate, I was looking for the one last rally. We see the rally here. You can see it in the light green. You can see it, oops, sorry. And of course, I'm clicking things. All right, here's the CRB. That's the key one. There's the rally that I was telling you about. But interest rates are starting to bite hard. We're also seeing some weakness in the economy. We're not in a recession yet. That'll come maybe in 6 months. But we're seeing a weaker economy. It's still growing. And so we're starting to see commodity prices level off at a very high level. Tips got a little bit of a rally here for the first time since somewhere over here. But gold's not responding that much. Okay, so now we have a little bit more clarity here. You can see that we've got 3 greens over here. We got 2 reds, and then 1 red over here. But you got to kind of look at this as a circle, not a straight line. In other words, this financials is kind of over here also. Do you see what I'm saying? So in other words, it's this red, you could almost think of it as over here. But the point is that let's just take a look at the greens for a second. The blue line is the is the economy. and all of our greens are near the high of the economy, and then the economy starts to falter, okay? But also, you can see when we look at the orange, this is the normal stock market cycle, and they're past the peak, and they're starting into really, we're past the market, and we're into the bear market. And so our business cycle analysis here tells us or confirms that we're in a bear market. Our trades, we got hit a little bit this week. I do have new trades here, but I'm going to get rid of a lot of the portfolio. So let's start right here. I'm going to hang on to ACGL for another week. We got hit hard here, but we're only losing a little bit of money. The purple predictor actually held up extremely well. So we'll hang on. It is a best of the best stock. We'll hang on just a little bit longer. I'm going to sell CVX. We never got the fill on the upside. Exit CVX and take a very nice profit. DAR, I'll hang on one more week. Purple predictor made new highs when the price was collapsing. So the smart money came in and bought this dip. I'm always on the side of the smart money. We're going to exit really all of our energy positions. So we're going to exit Dino at the market. Dow, however, this is very interesting because Dow, of course, Dow Chemical makes a lot of their products from petroleum. I guess the price of petroleum going down makes them more profitable. Also, look at the purple predictor. It's been skyrocketing, so the smart money's buying Dow like crazy. We're going to exit Devon Energy, another energy play. This is utilities. Got a little bit of a hook down on Friday, but we'll just keep moving the stop loss up here. Utes remain the safe haven where all the stock market money is going into. They're going into these kind of safe havens like consumer staples in here. New trade here. This is a 3 times bear ETF on emerging markets. And my thesis here is that when we have the dollar so strong, combined with interest rates so strong, emerging markets get killed because they borrow massive amounts and they're at record-setting debt right now. Emerging markets are at record-setting debt levels denominated in US dollars. So they're getting killed right now. I shouldn't use dramatic language like that. They're getting hurt badly. Is that better? But you know what I'm saying. We're going to start to see, it'll take a few months, probably 6 months, but early next year, we're going to start to see some emerging markets default on their debt. Obviously, Argentina will, because they always do. But we're going to see some other ones under a lot of stress. Turkey, for example, will be under a lot of stress. There's other ones as well. But all emerging markets will be under stress because of higher interest rates and a strong dollar. FAS, this one is a 3 times bearish financial stocks. Now, not all financial stocks are going to really suffer. Insurance companies, we were long Chubb and Travels. They've worked out pretty well for us. But banks are going to suffer a lot. The flat yield curve, the loan losses, and as you can see here, FAS is exploded, broke previous highs, so we'll buy it right now. Smart money's been buying FAS for a while. I'm not so smart, so I'm just buying it now. But you see what I'm saying. Banks, goodbye. See you later. We're going to exit LPLA as well at the market. We're going to exit MJ. We're about to be stopped out anyway. That trade just did not work out at all. We didn't even have a fighting chance on this one. We're going to exit NI, taking nice profits on NI. We were stopped out of NVIDIA. Well, it is what it is. We talked about it. Now, SJB, another inverse ETF, but this one holds junk bonds. So you heard my rap on junk bonds. You can see that junk bonds are about to, this is an inverse ETF. The inverse ETF is about to break the highs over here. We'll buy that break, which probably will happen on Monday. Okay, but this is, what we're doing here is shorting junk bonds. SQQ has worked out very, very nicely for us. We got into it down here, and now we're way up here. So we're already up quite a bit of money on this trade. Purple predictor, still bullish. Like I say, I'm just getting more and more bearish all the time, and this is not going to be a good year at all. We're going to exit travelers. We gave up some of our profits, a little bit too much. I should have gotten out sooner. And so, okay, so let me just stop for a second. Okay, so the bear market's here. I mean, we just have to be just bearish, period. I mean, we were able to hang on to some long sectors. Obviously, we still are. We've got EIX in the utility sector, and we've got some other ones that are doing well on the long side. But a lot of our sectors, finally, the overall market cracked them. And so I think we got to just completely swap our portfolio around here and start to press the short side, which we're doing by adding those inverse ETFs. All right, everybody, big changes here. Let's go make some money. Talk to you later.